Hey everyone, welcome back to CryptoCache. Thank you very much for joining me here. I hope you're having a fantastic day. Happy Monday to you, and you had a great weekend. Once again, I'm traveling, so the audio quality is not fantastic. Appreciate you bearing with me there. I'll be back within a few days here. So we're going to take a quick look at CVC. I got a lot of requests from this one. This morning when I woke up, I was like, wow, okay, I got to cover this one again and kind of see what's going on. It's been a little while since I reviewed it last, so we'll see what's going on. I've traded this in the past and done very well with it. But again, it's very spiky and it has a lot of candle wicks. So we just got to kind of recognize that. This is probably just going to be a quick best practice and what to do in this situation. Okay. Because again, history has a tendency of repeating itself, but doesn't have to. And oftentimes when you look at something like this, you can kind of identify specific trends. So we're going to look a little bit back and kind of see what's going on. So if you're new to the channel, not a financial advisor, love teaching people to trade, hope you can learn something today. And obviously, if you do, comment below or feel free to like and subscribe. Or more importantly, join my trading community. I have a trading community. I have an academy as well where I teach everything that I know. And obviously, we also have signals that I send out for every single trade that I take. So you can kind of follow along if you kind of like to understand how to structure your trades more effectively. So here's where we're at with CVC. First of all, big picture with CVC, it's again fairly spiky. So if we take a look at its history, it's done this before, right? These very large candle wicks, very large retracements, essentially. So it's important to kind of recognize that it has a tendency of wicking up and then wicking right back down to where it came from. And in most cases, best case scenarios, it's retracing at least 50%. And that's kind of standard because when it comes to an increase of this margin, which usually happens in a very short amount of time, and we look at that, that's like practically a 1 hour candlestick or 15-minute candlestick rather. We can see the price action is just going crazy for one moment and then it retraces immediately. So the best thing to do is to not FOMO in. It's important if you were to have gotten in at a lower price point to take some profits as soon as it hits a decent margin, right? So I mean, if it jumps up 30% in 15 minutes, you should probably get out of that trade because the likelihood of it continuing higher from there is pretty low. Okay, again, depends on the overall position sizing, etc. But generally speaking, a margin of that distance is pretty big. Right? I mean, it was 72% from bottom to top within no less than 2 hours. Okay, so again, that kind of stuff should be alarming to you because I mean, you take a look at Bollinger Bands, for example. Look at how significant that is, right? That is way outside the standard deviation lines, even on the volume weighted average price. So again, a handful of little things, kind of to help you understand in the future when this happens again. If you were to see it, take your profits while you can and run because the likelihood of it continuing that higher from there is pretty low. Now keep in mind, it is consolidating right at that 50% point. So if we take a look here and we kind of go up with the price action, we can see right at about 50% was the highest point which it averaged out, and now it's going below and just broke below the lower Fibonacci retracement level. So again, generally speaking, with something like this, we want to make sure that we are cautious and careful and make sure that I would say take your profits while you can because the likelihood of it staying this high is very low. Okay, so a lot of those profits are going to be taken. And again, it's complete manipulation. The price action gets shot up here, gets a lot of interest, and then of course they take their profits way up here. And we're all stuck with an average price right, right in the middle, right? So again, best to not just to kind of avoid that. So let's take a look at some other standard stuff so you can kind of see, what this might look like. RSI up over 70, immediate red flag, in my opinion. We look at its history. Anytime it's come up over 70, it comes right back down at least by 50%. Okay, 50% is like the standard. If it doesn't consolidate and retrace and bounce off 50%, then the likelihood of it coming down a lot lower is very high. Okay. And when I say 50%, if you just take this whole candlestick and cut it in half, that's effectively the halfway point. That is a major key level Fibonacci retracement level at 0.5. So that being said, if we look at the 4 hour, obviously the retracement is occurring. We've gone way over 70 on the RSI. This tells us we're extremely overextended, and there's no reason to stay in this trade. If you have a long position, you want to take it. I'm not saying you should short right now, but hypothetically, you look at its past. Why wouldn't you, right? It makes sense that it's overextended. It's going to continue to lose its momentum because once again, the volume is dying. Volume is dissipating and the price action is coming with it. Implies there's no more buying pressure and the selling pressure is on. So again, just kind of some things to kind of pay attention to. The cloud really has no bearing here. TT sequential honestly doesn't matter too much, even though we did hit a 9 and got rejected. That happened way after the fact. So in truth, we are 8 hours into this retracement, so we could actually see a bottom or a bounce somewhere off that lower Fibonacci level. But once again, I don't think that that's anything to really count on. I do feel as if it's just going to continue to progress lower, and you'd probably be better off getting out while you still can. Again, the key levels you want to kind of look at is, I would just say the Bollinger Bands on 15 minutes. If you're well outside those standard deviation lines, then you probably should either get out or expect a return, a retracement essentially, right? Same thing with the volume weighted average price. If you are outside those standard deviation lines, that's also a key indicator that the price is going to turn around. So there's a handful of little indicators you can use on smaller time frames to identify reversals. But again, big picture, it's not gonna, it shouldn't hold. I'd be very surprised if it continued further from here. Granted, it could continue upwards over the next few days, but right now, today, I would expect the price action to come down lower before it comes up. Now, we could see one little thing here, just kind of throw out there. We could see a support level here, right at the range of about 20, I would just say 20 cents even, as a potential bouncing point because of the fact that that was a previous resistance. And at this point, when it blew through that resistance, it could bounce off that level. Okay, so I would say if you're going to take a long and you're insisting on it, closer to 20 cents would be more appropriate than 21, just so you can kind of get the most benefit here. But again, this is not something you should be trading regularly. These are coins that are kind of hit or miss, and obviously you want to get in and get out quickly. But I would say get out if you're in this one here to the long side. Make sure you take some profits. All right, well, that is about all I have. Again, just a cautionary tale here. Hope you learned something today if you want to become a better trader. And all the whole 9 yards there with my Signal Group, Trading Academy, and community. Link in the description below, CryptoCache.tech is the site. Look forward to working with you. Hope you have a great rest of your day. Thanks again for your time. We'll see you.